Most ICT students or those that trade smart money concept or ICT concepts still struggling can spot a breaker block, a fair value gap, another block, or a liquidity pool, but they don't know why price is moving or what it's aiming for. And if you don't understand why, you keep getting in the wrong side. And that's just the truth. To trade the market as a smart money trader is not knowing where the other block is or able to identify fair value gap or just drawing out lines showing your breaker block. No, that's not it. You need to understand what price is doing currently, where it's coming from, and where it's going. You need to understand where is price going. You don't just need the concept, but you need context. Just like words don't make a sentence unless they are structured with meaning. Market moves don't make sense unless you understand narrative flow. And I'm going to be explaining how to define the narrative when you open your chart. All right. So now what's the narrative? That should be your first question when you open your chart. The narrative is a storyline of price. It answers what is price doing right now? The state of the market. Is it bullish or bearish? Where is the liquidity? And most importantly, what liquidity is the market hunting? Now, if you open your chart, these questions are very important. But usually we seem to bypass this process because we just want to make money. We're just looking for that simple strategy, that simple entry pattern, that simple way to just make money as much as possible. But you have to understand that when it comes to trading a market with ICT concept, if you don't understand narrative, you will actually struggle with trading because the concept by themselves don't work. They work with narrative. So these questions listed here are very important when you open your chart. They tell a story. When you open your chart, you realize that you can find many areas of market liquidity. But what's very important is knowing which liquidity is market running for. And for you to know which liquidity, you have to get the narrative. All right. Now, how do you build a narrative? Before you can understand how to build a narrative, there are three things you need to know, and that's what I'm going to be talking about. When I'm done explaining these three things, you'll have a very good foundation in building your own narrative. All right. The first is liquidity. Liquidity delivery. How is liquidity delivered in the market? You have to understand that liquidity is what drives price. And you are already ahead when you can define and identify areas of liquidity in price. Now, if you want to learn about liquidity, I'll leave a link to the video. As regards to price movement, price either creates liquidity or takes liquidity. Now, once price is moving, it's either it's creating liquidity or taking liquidity. You have to understand that. To be able to understand and predict price movement, the question now will be how liquidity is delivered. And it's very simple. Price moves from external range liquidity to internal range liquidity. Now, what is external range liquidity? Now, once price creates a range, probably a swing, the high and low is the external range. And then inside this range is what we call internal range. It's very simple. I'm going to show you an example shortly. So price moves from external range liquidity to internal range liquidity. And from internal range liquidity to external liquidity. It's that simple. This is how liquidity is delivered in price. All right, let's go on. So here's an example. We can see price created a range here from this low to this high. So at the high, we have external liquidity. At low, we have external liquidity. And within this range, we have the internal liquidity. So we can see as soon as price created this range, what happened? It left an internal range liquidity after taking this high. This is an external range liquidity. So we're expecting price to go back into the internal range liquidity. Okay. Now we can see that as soon as price fills this fair value gap, it ran lower to take the external range liquidity. This is graph of liquidity below this low. So it's an external range liquidity. Now, if this external range liquidity has been taken, where does we expect price to go? We want to look at this range that has been created. We're expecting price to go to internal range liquidity. Now, look at this carefully. As soon as price took this external range liquidity, what are we expecting? We're expecting internal liquidity to be taken. And from this high to this low, the internal liquidity we can find is this high. And what did price do? Price rally to take this high here. So we see external and then internal being taken. It was taken with this candle. But before it did that, this happened. Price created liquidity. So we're having relatively equal highs before running higher. What I'm trying to point your attention here is how to predict the next place price will go. Because you can see how price took out the external liquidity. Once external liquidity has been taken, what you should expect or what you should look out for is internal liquidity. And you can see it here. You may not be able to predict this movement here because price could as well just run higher. But as you can see, price rallied, failed to take this high, creating a new liquidity. And as it created this range, it also created a new liquidity here, which is internal liquidity. So now this high has been taken by this range. Where do we think price will go next? Because external has been taken and this move has created a new range. Inside this range, we have fair value gaps. And these fair value gaps are what? Internal range liquidity of this range. So as soon as this high is taken, we are expecting that price will retrace and go into this range to grab the liquidity. All you just need to know is what liquidity was just taken and what is the next liquidity to be taken. And how you can classify that is into external and internal. If internal has been taken, you want to expect external to be taken. We can see here, as soon as the internal range was taken, here, this fair value gap, we can see that it ran for external range. As soon as the external range was taken, we have another internal range liquidity here paired with another block. So understanding this, we're able to strengthen our ability to build a narrative. We don't just come here and expect that, okay, this is an order block. We want to what? Sell. Let me just take all this out. Here is another block, clearly. So you don't expect that seeing this other block here, you want to just start selling. You can see it did not work. Price did not respect it because there's a storyline going on here. Price is just coming from an internal liquidity. So where we expect price to go is external liquidity, which is here. So we don't expect this other block to hold. And already price is bullish. You can see highs have been broken and the lows have been preserved. So we are not expecting to sell in this market condition. Okay, so let's move to the next. Time frame alignment. Many people struggle with this a lot. Even I myself, when I was a beginner trader, I struggle with time frame alignment. I struggle with top-down analysis. How do I analyze the market? What time frame should I pick? For day trading, what time frame should I use for my entries? For scalping, what time frame should I use for as my higher time frame? I struggled with this for quite a while until I got this understanding. Now, as a trader, your primary objective is to know your trading time frame. Now we have position traders, we have swing traders, we have day traders, we also have scalpers, we also have short-term traders. We have traders also combine more than one or two styles of trading. But from a professional perspective, your trade setup should incorporate at least three different time frames: the higher, intermediate, and then the smaller time frame. So I'm going to be breaking this down. But the whole thing I want us to get from this is you want to structure your time frame to a higher, intermediate, and then a smaller time frame based on the style of trader you are. If you're a swing trader, you will have a different higher, intermediate, and smaller time frame. If you are a day trader, you have a different. If you are a scalper, you also have a different list of time frame. You don't want to be swing trading with a day trader time frame or scalping with a day trader time frame. So I've been able to break it down into a more precise roadmap. Each time frame for each style of trading. So we can see here we have position trader, we have swing trader, we have short-term trader, and then we have day trader. And then we have four segments for each time frame you should have with your style of trading. The first is the trade idea, second is institutional level, the third is bellwether, and then the last is entry. Now I'm going to be explaining these terms. Trade idea has to just do with where you get your bias, where you get price direction. Is where you identify the drawn liquidity. So it's just the time frame where you generate trade ideas. You just look at the chart and then you are able to tell, okay, price is going to move from here to here, from point A to point B. Then now, the institutional level has to do with your order blocks, your fair value gaps, your breakout blocks. So those are the levels you want to be trading off from. Then the bellwether is the time frame where you want to look for targets when you take a trade. and also confluences. So what do I mean by confluences? These are the concepts you want to now imbibe, like the power of three, the smart money tool divergence, the break of structure, the market maker model. So this is where you just refine your trade setup. Then the last is for entries. So I'd like us to understand clearly that these two areas here, the trade idea and the bellwether, are only for idea generation and refinement. And then this area here, the institutional level and the entry, are areas of execution. What do I mean? For a position trader, you can move from a monthly time frame to a 4-hour or 1-hour time frame for entries. For a day trader, you can move from a 1-hour time frame to a 5-minute or 1-minute time frame for entries. You can get an order block, an decisional level here, a 1-hour order block, a 1-hour fair value gap, or a 1-hour breaker block, and move straight to the 5-minute through to 1 minute for entries. Now, the mistake you don't want to do is you don't want to be using a daily order block, moving straight down to a 5-minute or 1-minute time frame for entries. I used to make those mistakes before. I would see price reaching for a daily order block, and I'll try to refine my entries in the 5 to 1 minute time frame just to get a better RR. Now, you can actually be correct. Price might actually move from that daily order block, but you realize that taking that trade will end up in losses because price can be finding support in another block, in a daily order block, and it will take 4 to 3 days for price to rally higher. Now you can see we have 1, 2, and then 3. And you can see the other candle rallying higher. But you are trying to enter on this day. So this very day can wake you out because you are using a smaller time frame, 5 minute or 1 minute time frame. And then even this day, you could be entering this day, and then price will still go lower for this day, go higher, go lower, take you out, and then rally higher. So you can be correct in the straight setup, but the time frame needs to align. So you don't want to be going to the daily or 4-hour to look for the institutional levels like the order block, fair value gaps. No, no, no. You want to start from the 1-hour time frame and then move to the 5 or 1 minute time frame. So for short-term trades, you want to move from 4-hour to 15 or 5 minutes. So you can take your time and pause this video to screenshot this so you could save for future use. Then the last is smart money concept or ICT concept. ICT has taught a lot of concepts, and is still pouring out a lot of concepts. As a new trader, a beginner trader, or still a struggling trader, all you have to do is pick a couple of concepts that you understand or feel drawn to and work with them. You don't need all the concepts, you just need a few. Now, concepts act as confluences. What do I mean? Now, this will help you when building a strategy. Let's say you have a very simple strategy. What you do is that if you are buying for that day, let's say you've established a bullish bias, you will be buying 5 pips below the market open. And if you are selling for that day, you'll be selling 5 pips above the market open. So now, on this very day, you are trying to buy. So waiting for price to go below the market open. So you're waiting for 5 pips. But then before this day, the previous day created a range, let's say swing high, and then we are seeing price retracing. Now, price has gotten below the market open. Let's say it's at 5 pips. You want to buy. Now, that's your strategy. But now, because you understand premium and discounts, you would measure from this high to this low. Measuring from this high to this low, price is at a discount, and you want to be buying at discount. Now, this here serve as a confluence. Now, you can as well include this in your strategy and say, okay, if I'm buying below the market open, 5 pips below the market open on a bullish day, I would want to see price at a discount. Now, you could do that, but it will also reduce the number of trades you will take. But my point is trying to include every single concept just on one strategy is not worth it. Another scenario could be, let's say you are trading the Euro USD, still same strategy, and then Euro did something like this. Let's say this is a swing low. Then we are seeing Euro taking out this low. So this is the day you want to trade. And let's say price is at this point. Let's say this is the market open. So you draw this line, and then you see price move below the market open. So if you take this swing high, the swing low, this point here will be discount. So you're looking to buy here. So the premium discount increases the probability of your trade. Now we can see that this swing low took out this previous swing low. But in the DXY, let's say the previous swing high that was formed, DXY failed to take it. So we are seeing weakness in DXY. And then something like this, just like we see here. Sorry, this is messed up. There's something like this. This is the day we want to trade. We are seeing price retrace into premium. Okay, now we are now including divergence, smart money divergence. This serves as a confluence. This increases the probability of a trade. But you can't just include in your strategy that before you trade, you must see smart money divergence. It doesn't happen all the time. In fact, smart money divergence is not an indication for a trade. It only supports your trade idea. So we need to understand that this concept only helps to increase the probability of a trade going in our favor. Now, the example we're going to be looking at is a short-term trade. Remember, we get our trade idea from the weekly or daily. Now, if the weekly is not clear, we'll go to the daily. Then we want to look for the institutional level in the 4-hour time frame, either if another block, a breakout block, fair value gap. Then the 1 hour is where we look for confluences like the SMT divergence, the power of three, premium discount, and as well, we can also look out for institutional order flow. Then this is the time frame for entries. So we're going to the daily, 4-hour, 1 hour, 15 minutes. All right, let's go on. All right. So this is a weekly time frame, and this is the week we want to study. So I want you to imagine with your imaginary minds or eyes that this candle is not here. So imagine this candle is not here. We don't know if it's bullish or bearish. We don't know. The only information we have is this candle to this candle. Now, one of the questions you want to ask yourself is, where is price coming from? All right, looking at this, you can see that price is bullish and price is reacting from what? This fair value gap. You can see this candle here. You can see price reacting. Another question you want to ask yourself is, what is price doing now? Now, you can see price is consolidating. The next question you can as well ask yourself is, where is price going? You want to identify areas of liquidity. So we can see this high. This low too is also a possibility, but it's of a lower possibility because one, we already established where price is coming from. Price is bullish, and we are seeing price reacting from this fair value gap. All right. So this high is more likely. This high and this high answers this question. Where is price going? Where is price likely to go? So we're expecting price to reach for this high and this high. So we've established our bias. And now, if this time frame is not clear enough, what you can do is go down to the daily time frame. Okay, so let's go there quickly. So here's the daily time frame. If the weekly time frame was not clear enough, you would move to the daily time frame for short-term trades. Okay. Now, you can as well repeat those three questions asked in the previous slide. Where is price coming from? Where is price likely to go, and what's price currently doing? So just not to make this video too lengthy, we're going to skip that. But the first thing that jumps to you is this order block here. Remember, this is what we are studying. This week here, we're studying Monday, Tuesday, Wednesday, Thursday, Friday. Now, imagine you don't have this information. The only information you have is this candle to this candle. All right. So we can see that price is currently at what? An order block here. Second thing we can also observe is liquidity delivery. Price recently took the external range liquidity here, this high. Let me draw it out. You can see that this high was taken, and the price retraced into this range from this low to this high to what? Take the internal range liquidity. Now, if the internal range liquidity is taken, what is the next liquidity do you expect price to run after? The external range liquidity. So we're expecting this high to be taken. Another thing you should also understand is if you draw your fib from this high to this low, you will get equilibrium here. And then if you draw your fib from this high to this low, this will also give you equilibrium. This blue line here is equilibrium. This is premium, and then this is discount. Already we can see that we are imputing these confluences even in this time frame. So I just want you to flow with me as we build narrative. Now, this is a Monday. As Monday prints, you don't want to go down to 5 minutes or 1 minute to look for entries directly. No. Remember, let's go back. Let me show it to you. For short-term trades, you want to move from the 4-hour time frame to the entry, not daily. This is only for trade ideas. And this as well is for. Now, you can as well take trades from the 1 hour. If you see another 1 hour order block, you can as well take for short-term trades. But then the very good thing you need to understand is you don't want to go further from the smaller time frame. And then you don't want to also go too close to the smaller time frame. It's just like you want to day trade and then you are trading off a 15-minute order block. Now it can work, but a 1 hour order block is stronger than a 15-minute order block. A 4-hour order block is stronger than a 1 hour order block. Okay, I hope we just get the whole concept. So here's the daily time frame. I said three things. Liquidity delivery, price has taken the internal liquidity and we're expecting external to be taken. That's one. Secondly, we are seeing price reacting from a bullish order block in the daily time frame. So we expect that price should rally from this point here. And then thirdly, we can see price is at a discount. Using this range from this high to this low, this will be a discount. And then from this high to this low, here will be our equilibrium and we are seeing price at a discount. All right, let's move on. So here's a 4-hour time frame. Now, it's at the 4-hour time frame for short-term trades. You want to identify the institutional levels. And you know what the institutional levels are, the order block, fair value gap, breaker, and so on. Now, if you look at this, this is the week we are studying from here. I separated it with this line. So here is Monday, Tuesday, Wednesday, Thursday, Friday. And then this is our equilibrium. And then this is the daily order block we saw in the previous slide. So this order block here. So here it is. Here is a weekly open. This is where price open. So we are imputing the concept of power of three. The best buys occur below price open, and the best sells occur above the market open. So you can see how price dipped below. Now, it doesn't mean you must buy below. You want it to be either below or close to the open. So you can see you want to measure the here. So your entry. So if you imagine you're entering here, it's far from the open. You don't want to be entering this distance. You want it to be close to the open. So the best is below, but you can as well buy at the open or a little bit above the open. I hope that's clear. So at the institutional level time frame, all you want to do is to identify institutional levels. So as price begins to print, you will see that here price created an order block. Now, this is a high probability order block. I'll leave a link to a video where I explain high probability order block. You can see it has a fair value gap. So we're expecting price to rally from here. And then we have what? A fair value gap. Or you can see how price reacted and it rallied for this high. This is a short-term trade. A short-term trade, you're just looking to trade the week's expansion. And you'll be very lucky to have two opportunities. So you can see we have two opportunities here. You're just looking for one opportunity. Not 3, 5. No, this is just 1 week. Another opportunity will come another week. So we have 1, 2, which is very good. Okay. So here's our 1 hour time frame. Remember, the 1 hour time frame is our bellwether tool. We're looking for confluences. So here's Monday, Tuesday, Wednesday, Thursday, Friday. And this is our weekly open. And then this is the high we are targeting. So if this high here is this high, let me just show it to you. Sorry, this high. This is what you can see, this line here. Okay, good. Now you will see that I added blue lines here. These blue lines represent the daily open, the open for that day. So using the power of three, you want to be buying below. So on Monday, you can see price did not really go below the open. Tuesday, same thing. But on Wednesday, you can see price went below the open for rally higher. Thursday, price went below the open for rally higher. And then on Friday, price went below the open for rally higher. So on Friday, the trade objective has already been achieved. So you can see this choppy mode. So now we want to go straight to our institutional level from the 4-hour time frame. But in the 1 hour time frame, we're refining our trade. You can see how price reacted here on a Wednesday, going below the market open. You can see that here. And then the second opportunity, which is the 4-hour fair value gap, price went below the market output. So this increases the probability of this trade setup. So we're looking to buy on Wednesday and Thursday. But actually, I would like you to understand that the best times to buy for short-term trades are on Monday, Tuesday, and Wednesday. Thursday, Friday, we're already at the end of the week. So the best times are Monday, Tuesday, Wednesday. You get the best setup. So you can see, imagine buying from here and then take your profit here. Look at the range. But you can see here, the range here is reduced. All right, so we're going down to our 15-minute time frame, which is our entry time frame for short-term trades. So here's our 4-hour order block on a Wednesday. And then these are daily open price. This is the market open for the day. So the entry pattern we're using here is the ICT 2022 entry model. That is the break of structure plus fair value gap. So you can see how price broke structure here after taking this liquidity, finding support at this 4-hour order block. As soon as it broke this high, it created what? Fair value gap. As soon as price returns into this fair value gap, it gives an opportunity for an entry. So you can see how the trade played out. Then on Thursday, we can see this huge sharp move, sharp decline below the market open, finding support at the 4-hour fair value gap. And then we see this rally breaking this high. As it breaks the high, created what the fair value gap, giving opportunity for a buy as price returns into the fair value gap. And you can see it is below the daily open. Now, something I failed to mention, if you look at this carefully, you will see that this is the London close. I did not identify it here, but here will be the London, New York, and the London close. And you get the best swing trades and as well short-term trades at the London close. Here is the London, and here is the New York Q zone. So it's also a confluence to add. There, another thing again is if you use the previous day's range from this low to this high, you can see how price retraced down into what discount, finding support where the 4-hour fair value gap before breaking this high and then rallying. Okay. Now, this is just to show you the risk reward. If you'd have taken this trade from this point here, which was stopped below this low, taking profit at this external liquidity will give you a 4R. And then if you leave it for that high, you get a 6R for a short-term trade. But if you are trading on a Thursday, remember I said Thursdays, Fridays are not days you want to trade for short-term trade. You can take day trades, but not short-term trades. So if you are taking a trade, you'll be coming out with less than 1 hour here, but 2.5 hours here. All right. I hope we've all seen how we got the trade set up by building a trade narrative. So we don't just look for any other block or any fair value gap in any time frame using any concept, trying to squeeze in multiple concepts to form a trade setup. No. All you want to do is to look at price and try to read the narrative, try to read the storyline. Now, this simple video may not give you all you need, but I'll be honest with you. No single video will give you the ability to be able to read price accurately. What will give you the ability is your practice in the charts. Rather than trying to hasten the process, trying to make money here and there, I want you to sit down and journal trades. Look for examples in the marketplace. Study how price moved from one point to another. This is where we build experience and more confidence. So I hope this was helpful, and do well to like this video and subscribe if you haven't subscribed. And as always, I wish you a good luck and good trading.